Hey, hi everyone, and welcome to today's webinar. The title of today's webinar, Unlock the Secrets of SMSF Property Valuations. My name is Jeevan Toki and I'm Head of Product at BGL. I'm joined by two people today, so Nathan King and Paul Robbins from Acumentis. So guys, welcome to today's webinar.
Thanks very much.
Thanks, Jeevan.
Do you want to maybe both spend 30 seconds, maybe just giving a quick introduction for yourselves?
Oh, yeah, certainly. Morning, everyone. I think it's safe to say morning. I'm based over in WA, but I have a national role as a national director in advisory. And look, one of my core services is dealing with accounting firms in relation to services that they may need in the property space, which range from the self-managed super fund, which we're talking about today, tax depreciation and general valuation and advisory work. Thank you.
Thanks, Nath. And morning, everyone. I'm based in Brisbane. Work closely with Nathan. Have been involved in developing the SMSF product that we'll talk about today. Yeah, do a lot of different type of work, particularly with accountants, family law, tax depreciation as well.
Excellent. So today's session will be recorded. So if you do need to take off early or miss any parts, we'll get a link to that recording and it is available on our YouTube channel. Any questions you do have for any of the three of us, please enter them in the Q&A panel and we will stop periodically to check those and answer those questions. So before we make a start, I'm going to run a quick poll there with the audience. So I'll just launch that now. So we'd like to know really about yourself. So you should see that now popping up, what your role is there with SMSFs. And the second question there is, what is your experience there with property valuations? Nathan, you should be able to share your screen now. So we'll just give that maybe another 10 seconds. Okay, so I've just shared the results here. So as you can see, probably the vast majority of our audience today are accountants. Looking there at the results. And I guess it's good to see, I suppose, a vast majority there, the guys of the audience, 38% has got no experience with property valuations. So which is great because Nathan and Paul are going to do their best to, I guess, provide that expertise. And you can see a lot have had some experience there with auto vals and desktop valuations. So Nathan, I'll pass over to yourself.
Great. Thanks for that. And look, thanks to Jeevan and BGL for the invitation to come along today. It's appreciated. Look, first of all, a bit of a disclaimer for myself is that, look, we are property professionals, so we're not auditors or accountants. So look, we're more than happy for feedback, questions as we go along. And there may be some aspects of the self-managed super fund and the ATO legislation requirements that you may share with us today. So that'd be great. Look, the agenda and what we're going to run through today, we're going to talk about the ATO legislation and guidelines from a property perspective. We're going to talk about the aspect around significant events affecting market value and also the market movements, which is related to that. And then there's going to be a bit of a demo on the system, on the BGL system. And we'll finish up with a wrap up and questions. But look, if there's any pertinent questions as we go along, we're happy to answer them on the hop. So, assuming everyone can see my screen okay. So just an introduction to Acumentis for those that may not be familiar with us. Acumentis is Australia's only independent property valuation advisory service that's also ASX listed. Last count, we had 45 offices across the country, so we've got good national coverage. Most recent office we opened late last year up in Darwin. But look, we've got a very strong regional presence, and look, we get around pretty much most parts of Australia when required. So we've got local experts in all those markets, and we look after and look at residential, commercial, agri properties, as well as specialised sort of commercial assets as well. So like as mentioned, we look after residential, commercial and agri. We also have an asset advisory team that does a lot of financial reporting for clients, for government, for corporates. And we also do a lot of work in the insurance industry, particularly at the moment with rising insurance costs. That's a service that's in demand at the moment. All right, into the fun stuff. So the ATO legislation, as mentioned at the beginning of the presentation, we're sort of brought a property professional lens to the legislation and our interpretation and how we actually deal with the self-managed super fund valuations and requirements. So look, first and foremost, the legislation and guidelines, as most of you on the call would probably know, there's an obligation to report on your self-managed super fund assets every year to your auditor. And look, the assets must be valued at market value. The definition that's provided within the guidelines for market value is it's the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing and where the parties had actually acted knowledgeably, prudently, and without compulsion. So that's a fairly standard definition that's, works across a whole facet of clients for us in the property valuation industry. Then it goes on and talks that it must have clear methodology and approaches must be adopted. So in simple terms, for a residential property, the most obvious methodology would be a direct comparison approach. So you're looking at other comparable properties and comparing them back. An exception to that where you might apply another method could be a service department where you might look at the income approach and the direct comparison. When it comes to commercial property, we would again look at the direct comparison, but the income approach, because quite often it's a leased investment, particularly self-managed super fund, we'll look at that income approach. There is also for unique assets, you might look at a cost or a summation approach if there really is a lack of evidence available. And for more sophisticated assets, you might run some other modelling around hypotheticals, cash flow analyses, etc. So the methodology, there are a few methodologies, but it's very important that when you receive a report from, in relation to self-managed super fund market value, that's clearly spelt out how they've looked at it and what methodologies they've actually applied. Sorry, I'll jump ahead. So look, valuations must be based on objective and supportable data. So our interpretation of that is that you must have market evidence within the report. So if you're using, a direct comparison, it's the sales evidence and analysing the sales evidence into particular rates per square metre. If it comes down to commercial, also if it's an investment property, it'll be the market yield analysis and evidence that you want to provide. So basically, again, reading through the legislation, the auditor's responsibility is to check the asset has been valued correctly with supporting documentation. Now, we've been working, myself and Paul have been working in this industry for over three years now, specifically providing the self-managed super fund. And look, over that period, we've refined our report because we really have understood what's causing the issues in that supply chain and the reworks and the aggravation. And a lot of those conversations have been with auditors and trying to really understand what frustrates them within the process. So I'm not sure if everybody's seen this, but in March this year, the ATO had a bit of a press release in relation to some analysis they've done in relation to the market values on self-managed super funds and their returns. So importantly, it's the key responsibility of the self-managed super fund trustee for every income year to value your fund assets at market value. The auditors are required to check those and to make sure that they've been valued correctly and assess that the supporting documentation is appropriate in that particular instance. Now, the ATO basically flagged that they're using data more and more intensely to sort of ascertain, I guess, and identify any, I guess, shortfalls in following these guidelines. And in this particular article, they identified 16,500 funds that had basically retained the value from 1 year to the next year. And they'd also identified a number of funds that had adopted the same value over the last 3 years. Now, later in the presentation, we'll talk a little bit about the market forces and significant events. And look, I think it's quite clear that, you know, assets, majority of assets would really be the exception of the rule, where the values haven't changed on a year-to-year basis.
Nathan, just before you jump forward there, I'm just looking at a couple of questions. I thought I might just a couple of them. First one from David Gunnawan about does the property need to be valued every year or every 5 years? Well, I guess you've just touched on that there. I mean, ultimately, the trustee needs to ascribe a value to it every year, and it's probably they need to consider whether there's been significant movements or a significant event in the market to determine whether it's appropriate to go and seek some independent advice. So there's no, you know, hard and fast. It needs to be valued by an independent valuer every year. But certainly, if there's changes to the property or changes to the market, you need to go and seek some advice to understand what the implications that are for your property. There was another question there in relation.
Sorry, Paul, I'll just add to that, and
Yes.
look, just add to that. So if you are sort of using the same valuation as you did the previous year, you still have to justify why that's appropriate. So you still really have to go through a similar type process and basically, you know, provide the supporting information, evidence as to why you believe that valuation is still relevant.
Yeah, thanks, Nate. And just there's one more. There was a question, can we just get a letter from the local real estate agent saying it's worth X, you know, number of dollars? Well, look, if that real estate agent has supportable data backing up that number, comparable rents and sales, and talks about the methodology which they've used to derive that value, then that is okay. But generally what we've seen is sort of a one-pager, and that will not stand up, I guess, when it gets to the auditors, in our experience. So there are a couple of things just to consider. And there was someone's question that unfortunately I tried to type an answer to, but deleted it. The question was around whether you can go off the local council value of the land in relation to market value, and the answer is no. You know, maybe 10% of the time, if you just held land, it might be similar, but in most instances, and it's good for all of us, the council valuations are generally slightly conservative, which means we're paying rates and land tax on a slightly lower number than it would ultimately be if we put that property to the market. So thanks, Nathan.
Thanks, Paul. And look, in relation to other, I guess, professionals outside of, I guess, the valuation industry providing reports, Paul's going to run through a little bit later, you know, some of the important aspects that go into a valuation report. And it's not prohibitive that others can actually provide it. But from my discussions and over the last 3 years, a lot of them don't include all the information required. So there's quite often a fair bit of rework that's involved. And that rework can quite often attract additional fees if it's not done right the first time. So look, but just back to the article. Thanks for that, Paul. I think it's great to get those questions as we move through. So look, the last point in that article, it just refers to the market valuation for tax purposes. So some of you may have scanned that QR code, but if not, you'll see that when the presentation gets released. But that actually provides the guidelines to the market valuation for tax purposes. And I'll just quickly run through some of these aspects. Now, look, we've probably covered a few of these off already. But look, I guess the main point here is that if you're getting a property professional to prepare these reports, they are experts, and it's an actual person that's sitting behind preparing these reports. So if it ever comes into question or there's actually a query on the report, you can pick up the phone, send a message, communicate with that individual as to why you think maybe the valuation, you've got a query about a valuation, the rental adopted, et cetera, et cetera. But we're also there, and we can explain to a third party, if required, your auditor or something like that, in relation to why we've arrived at the value that we've had. So I think that's an important aspect. And we are, property valuers are tertiary educated professionals. It's usually probably a minimum of 5 years to obtain all the accreditations and become a certified practicing valuer with the API. All right, I'm going to hand it over to Paul just to run through how that sort of relates to the valuation reports that are released.
Thanks, Nathan.
I'll flick through as you require, Paul.
Yeah, no, that's fine. Look, I guess it's probably worthwhile just flagging up front. I'm talking from the perspective of a commercial valuer. So this is sort of non-residential work. I know a lot of people will use CoreLogic, and some of those platforms to do residential valuations, and that is fine. It's when, I guess, the return is of a sort of questionable confidence or low confidence, that might be when you might consider sort of reaching out to us, because we certainly do a lot of work in the residential space at the moment. But just my comments in the next few slides are sort of specifically around a report that an SMSF might request from us. Obviously, this is from the accountant or the trustee themselves direct. It allows them to, with confidence, ascribe a value for their asset every year. This product is a sort of a desktop restricted assessment. So we'll go through later the sort of data that we ask of up front to assist us. Nathan mentioned we've got 45 offices around Australia. We've got a database with 20 years worth of commercial evidence. And when I say commercial, I mean office, industrial, retail, agri sales, rural sales as well. And then we dive into very specialized assets as well that some people might hold in super funds. In fact, I just did a childcare, going concern childcare centre, single asset SMSF. An $8 million asset. They own the land, the improvements, and the business as well, and they're trading that successfully. So we get involved in a lot of different work. Having said that, that type of valuation wasn't undertaken on a desktop. We recognise that specialised assets need to sort of have a little bit more care and a touch to make sure that we're doing it appropriately. So Nath, if you just wanted to click over the next page here, and maybe look, our document's probably for a maximum of probably 8 pages long, but the key things that we have identified here for you, obviously we can't see the smaller text, so we've dragged out to the left the main points. Getting the reliant party right, getting the self-managed super fund name right, exactly right. That's the information we get from you, but we know that that's very important. Owner details, and then even on that page up front, the first page you come to is like basis of valuation and the definition of market value that the Australian Tax Office has indicated, Nathan spoke about earlier. So those things are all up front, sort of to allow people the confidence to work through the report. Yes, got this, got that, got the basis of valuation right. If we go on to the next slide then, Nate, we've got some further data there, and some of these pages are just good information relevant to it. Here we're talking about the methodology. Obviously, even if the asset is sort of held in related entities, there's generally a related party lease involved. And we understand the importance of those related party leases, but we also understand that we need to test those leases against market-based evidence. So, we will find from time to time that a rent is super inflated or, potentially could be unders, generally more so inflated, and we will have to make a call on that. And we will have to say, if we don't believe that's in line with market, it's a science, I guess, to some degree. I mean, if the rent is there or thereabouts, we'll accept it. But certainly, if it's sort of 20% above what the balance of the market's playing, we will have to bring that rent back, and that will, obviously cause some, further discussions. But that's the process, I guess, of what we do in making sure with confidence that we've got the right, not only the right market value, but the right market rent as well. There we show our assessments that Dave just came through there, direct comparison and the capitalization approach. And then the next page, this is essentially where we have our reliable data. So that first graph there is showing the market yields on an income approach, the yellow lines being the sales evidence we've considered, and the blue line being the adopted capitalization rate for the subject. On a direct comparison rate, again, building rate, and our adopted rate. And then the final table at the bottom there is the rental evidence. So we compare rents against the subject property, generally on a rate per square metre of lettable area. And we can see there the sort of cohort of evidence is sort of, there or thereabouts to the subject. So we've adopted our rent there, which I can't read, but $400 a square metre or whatever it is. So that's your supportable data and evidence. Nath, is there another slide on that one, or that's about it?
Yeah, this is the last slide. And look, I might just jump in there, Paul. There's a question that David Gunawan has asked about a real estate agent giving a range from 500 to 700. Is he counting, pick the higher or the lower of that range? Look, that's one of the things that's been really identified, that although, look, you might provide a range in your rationale and your comments, we know that a specific number needs to be adopted for both the market rent and the market value, and hence why when we provide our summary, we're very clear on adopting that single point. So there's no rework that's required in the mix.
Yeah, great. And then obviously the final page there, we've got everything that's required market value. We've got the gross market rent and the net market rent. So everything that's required, as Nathan said, we've been doing this product for 3 years with some refinements. In fact, sort of an endorsement to the product is we've got auditors referring business to us. So, I guess it's got everything in it that a lot of auditors, are satisfied with to help them sign off on their component of it each year. Thanks, Nate.
Thanks, Paul. Okay, there's a few questions coming through, and some related to 3 mil caps. So look, just one of the questions was asked, will the ATO be forced into a position of making a more definitive ruling of market values of the 3 mil cap gets through? So look, obviously a fairly controversial bit of legislation that's being introduced. And again, look, talking from a property perspective and really based on my readings around it, and I know that was challenged, and as I believe it's been challenged unsuccessfully, and that the draft legislation will take effect and basically will remain unchanged. And I think that I guess the controversial aspects of it is that there is no specific indexation, although as I understand it, the government can introduce indexation down the track if they feel it's appropriate. And obviously it's a taxing on unrealised gains. So, I was at the Self-Managed Super Fund National Conference. We had a booth there for the first time. and the number of delegates that came up and asked the question, you know, what's going to happen to the $3 million cap? Is there going to be more scrutiny on valuations? And look, time will tell with that, but, you know, from the recent article that we went through from the ATO on using data to look into, you know, valuations that haven't actually changed, you know, one would assume that there may be more scrutiny in this space. My readings in the article and the findings of that is, you know, that the impact at the moment will be small proportionally, talking about 0.5% of all superannuation account holders. I don't know, you know, whether, you know, everyone online has a particular view about that, but obviously without indexation, that will impact more and more people, one would assume. And then obviously the unrealized gains, particularly if, you know, they're sort of asset rich, cash poor, could be quite a imposition on some people when the tax is introduced. But that report that I was reading also went on that the superannuation trustees have an obligation to keep sufficient liquidity within their account to meet all their obligations. So again, I'm not saying I'm an expert in that area, but it's a question that we're often getting asked about what is the impact of the $3 million cap. And I would say that there will be more scrutiny on valuations moving forward is what I would believe will occur. And we're already seeing that happen.
Can I just jump in there? I just read an article yesterday. Meg Heffron was writing in the AFR. I don't know if anyone sort of picked that one up. But you know, ultimately, the date is the 30th of June 2026, and this is assuming the legislation actually goes through Parliament. But that is going to be the date in relation to the $3 million cap, where people will need to sort of have a look at what assets are in the SMSF. So 2026. That date. Someone did ask a question. It's sort of relevant, I guess, in terms of dates, Nathan. So I'll just jump in and have a look at that one. Someone said, if you're unable to obtain valuations for the 3 years prior, well, look, depending on the type of property, in fact, we can do retrospective valuations back 20 years, and I've had to for capital gains, different sort of purposes. So we can always undertake a retrospective. It's a benefit, I guess, of having a large database over many years. So we're often asked to do retrospective valuations for one reason or another. So not a problem to be able to do those at any point. Thanks, Nate.
Great, thanks, Paul. All right, look, just looking at the time as well, just having a look at that, we are sort of halfway through. So I will, so what I wanted to sort of touch on now, and I'll move through this relatively quickly, is in relation to valuations, the ATO guideline says, well, if there's a significant event that affects asset value, that you must look at the market value again. So really the question I've got is, what constitutes a significant event? So the legislation says obtain a new valuation of that asset if there's been a significant event, obtain alternative evidence to support the value of the fund asset, or get a valuation if there's been a material change in that asset. But look, I think most of us, and it specifically references the COVID pandemic. And look, I'll run through a few slides. I think that the landscape has definitely changed for us. We're not really following traditional property cycles at the moment. And the next few slides will sort of illustrate that point. So, pre the COVID, things were sort of humming along, and a traditional sort of this is a residential stats for those that are looking at it. And then you can see some artificial stimulus coming into the market from the governments. You can see interest rates changing, and you can see how volatile, the market's actually been with, and this isn't just that the values have gone up. You can see some dips there as well, and that will continue to occur. But I think if then you get into the particular states, you can certainly see that one number doesn't fit all. You can see that different sort of capital cities and metropolitan areas are definitely moving at different paces to other markets across the country. And that would probably even be more highlighted when you get to regional locations across Australia. So it's really important, particularly when you're looking at residential assets, that you sort of give it that scrutiny and your gut feel, and really sort of step back and go, all right, look, we've got this information. This is quite a unique suburb where you've got a lot of different characteristics. It could be a freeway one side, it could be a river there. You've got units, you've got prestige homes. So really sort of step back and make sure that, the data that you're getting, if it's come from an AVM or generated, sort of step back, use your gut feel. If it's a low confidence, go out there and just get a second opinion. Because I think that it certainly works in some sort of more generic type areas, but definitely doesn't work across all areas. Paul, I think you're going to talk about the interest rate changes.
Yeah, well, look, I mean, obviously, we all know the impact of those. I guess what we did see in those emergency periods, where money was very cheap, was massive growth in residential, but we also saw that in the non-residential markets as well. The one thing that we have noticed, however, is since the increases in the interest rates, and this, generally speaking, the residential markets are continuing to perform strongly. However, the non-res markets have been impacted by the rate movement. Everyone's looking at what their interest rates are if they're looking to buy either an investment, if they still want to try and maintain the similar sort of returns, but they're paying extra each month for the mortgage, they've got to sort of pay less ultimately for the asset. We've seen that play out on a smaller end of town, but we've also seen it play out at the big end of town as well.
Thanks, Paul. So I guess part of the reason perhaps some of the interest rate adjustments and increases haven't impacted some of the residential markets as much as you would think is the migration story. Now, so all these are significant events that have happened in our market since the pandemic. Government's obviously trying to curtail that, and they're expecting this to sort of fall over the coming years. But this has really added to what we have is a critical housing shortage across Australia, whether you're trying to buy or trying to rent. So these are significant events that are impacting property. And then you add into that, we do a lot of work in the insurance industry, but prior to the pandemic, for the 10 years prior to that, you'd say that it was fairly stable construction costs. But with the pandemic, on top of that, we've obviously had natural disasters, all these kind of things that really do impact supply chains, external sort of conflicts overseas. All these play a part. So in my time, and I've been in the industry for 30 years, I haven't seen this many of significant events that are all sort of unfolding at the same time. So more than ever, if you're adopting the same figure that you did the previous year, that's fine. People can do that, but you really need to step back and go, is that appropriate? And what supporting information and data are you providing to support that value is still relevant? We'll whip across to Paul just to give a bit of a commercial perspective.
Yeah, thanks, Nathan. I mean, look, we probably have all read about the impacts from COVID and work from home. So sort of the occupancy levels in the offices around the major capitals, Melbourne probably the worst hit, is quite low. So sort of a flow-on effect from that is that a lot of retailers in the CBDs are struggling, because you just don't have the same level of foot traffic in there Monday to Friday. And we've also seen, obviously the demand for new office accommodation over the last few years has waned, and asset values for the real estate investment trusts is sort of off 20-25%. They say that they're now sort of leveling out, but we've seen some major shifts. So if you've got clients with assets in those sort of city markets, yeah, look, there's certainly been some impact. Probably not as much in the suburban markets where people have actually enjoyed the work from home and are now looking at sort of potentially building an office around a sort of suburban location with some good transport. So the incentives is one thing that everyone needs to look out for. If you own office, they talk about the incentives, the level of incentives you need to give away. I mean, sometimes you might say a rent's $1,000 a square meter, but the tenant gets a 40% incentive, which effectively means all the tenant's paying you $600 a square meter. So incentives have played a major factor in office valuations over the last couple of years, and incentives are still pretty high, so we just need to look out for those. And really the only new assets that are getting built in the cities are being driven by new ESG standards, and we've got one in the city down on the water there. You've got massive corporates who are signing up for big rents because they tick a lot of ESG standards for that business, and they're great assets as well, don't get me wrong, but that they're also there's more than just the demand for the office accommodation. There's other demands driving businesses and their decisions. So that's the sort of level of construction we can see more focused at that type of market. In the industrial market, yeah, it's remain resilient. There is a large owner-occupier base in industrial, so a lot of people do own their own, manufacturing shed, and that has consistently grown year on year, and it's still quite strong, even though we've seen interest rates increase. And it's probably because for the first time, people are able to get some more rental growth out of their industrial buildings. For a long, long time, they might have sat around $100 a square meter, $110, $120 per square meter. Now those rents are $180 a square meter. So even though the investment yields might be softer, they're actually getting a little bit more income out of these assets. So the actual capital values have been preserved. So that's probably the one part of the market to look at the moment, I guess, is food and beverage. Just to keep an eye on that, because obviously with the cost of living impacts, I think that's where we'll probably see some more sort of failures, I guess. Some depressed rents I've seen. People struggling to pay their rent, so they're looking for some sort of renegotiation with landlords. So probably one of the markets just to look out for at the moment. Thanks, Nate.
Thanks, Paul. So look, just to summarise, significant events, it's probably open to interpretation, but from, I guess, a valuation perspective and being in the property industry, I really feel as that we are in uncharted territories in a lot of ways across the country, across residential, commercial. There's a lot of questions I noticed on the chat about agri valuations as well, even some unusual assets like solar farms. Look, we do have experience and can provide valuations, particularly in rural property, specialised rural, and we've had some experience with energy sort of farms as well. So thanks for those questions. One of the questions, Paul, they also asked is, well, what if there is no comparable sales evidence? I guess that comes down to sort of methodology and perhaps with the going back to the guidelines, adopting different methodologies based on the particular asset that you've got. So you really need to match the methodology to the asset that you're looking at. And if it's quite a specialised asset, you might be relying more on the income approach. You might be even looking at it on a summation approach. Don't know if you want to add to that, Paul.
Yeah. Look, that's a great question. You know, it's always nice when the property next door is exactly the same and sold last month, but generally valuers are always making some adjustments, whether the evidence is far superior and we're making an adjustment to reflect the fact that we're not as good, or we have to make an upward adjustment because our building is more modern than the transaction that we're comparing it to. So, you know, perfect world, we've got very good comparables. But generally speaking, when we're doing these assessments, we mightn't have anything that's directly comparable, but we can make adjustments to the transactions that we do have, to you know, bring some order to it and to, you know, explain our methodology as to why we've come up with a number based on the evidence that we've had to look at. So yeah, we can certainly work our way around that. In fact, it's what we do every day with our job.
Thanks, Paul. So we're just going to hand it over to Javan, who's going to basically just walk through how you can find our services through the BGL ecosystem.
Excellent. So thanks, Nathan. So now logging into Simple Fund 360. So I suppose most users should be obviously familiar with what you see. For those that are unfamiliar, on the investment dashboard, there is a property dashboard. So you can see there on the left-hand side, I'm going there to investments and then property dashboard. This will list all the properties which either the SMSF, or if you are using Simple Invest, either the trust or company holds, and you can enter those in obviously accordingly. You can do things on this screen in addition to the valuation, store things such as the last time the rent was reviewed or when the lease was expired there as well. You'll see the option, the button there towards the top right hand side, which is external service providers. So you're able to click on that, and then you'll see Acumentis there at the top, which is great. That will take you there directly through to the site. So Nathan or Paul, you might have to provide a bit more assistance to myself, but I'm assuming you click there on order a property valuation and just enter the relevant data.
That's correct. Yeah. So if you scroll down where you can see obviously self-managed property valuations. We also do tax depreciation schedules and just general property work. But on this screen here, we just want you to sort of nominate who's instructing us. It could be an accountant, it could be the trustee. If you click on, we talked a little bit about retrospective, so that'll bring up a specific date if you click on that. So you can put that specific date in there. If you need multiple dates, and I think that was one of the questions that was raised, if you need multiple dates, we can certainly facilitate that. That'll just need to be done on a quote basis, so that'll come through the system. And then when you're through here, obviously we need information on the self-managed super fund property address. We've got there about the transfer of sale. So if it is a sort of it's not for audit purposes, but it's more for a transfer, that's when we'll just contact you directly and have a conversation about that. And that's when a full sort of internal inspection is more appropriate. When you click on, say, commercial industrial, if you want to click on that one for me, you'll see there that the parameters come up. So with commercial property, it's up to 2 tenants before we'll need to quote on the job. So if you said just up to 1 mil there, and then you'll see that the price populates down the bottom. And if you just scroll to the bottom again, just keep scrolling for me. There's been a few questions just raised about pricing. So if you scroll a little bit further, you'll see the agri at the bottom there as well. So for those that have raised questions about pricing, it's all there as you link back through, and as you make your selections, that'll automatically populate the price as well. So look, we try to make it as easy as possible, as simple as possible for people to come through and request a self-managed super fund sort of valuation, but we're always open to feedback. The product and the services evolve through that feedback. So if you do use the system and have any feedback, feel free to certainly get in contact and let us know.
Thank you. So Nathan, do you have more slides to show?
Just had a couple just to finish off.
Swap back then. Meanwhile, I was loading, Paul, there was a question there from Larry. They've got a fund that's got 25 commercial properties, I guess.
Yes.
Is there any sort of, I guess, bulk discount in that sort of situation or anything available from that perspective, you know?
Oh, look, there definitely would be, and that would have to be an offline conversation. You obviously couldn't be able to sort of enter that through this portal. This is probably more for one-off, two-off. But certainly there would be. We just need to have a chat directly about that, get the addresses, and sort of price that.
Yeah. Thanks, Paul. And look, if people do have large portfolios, it can be a bit daunting to go through and add all these individually. So if somebody wanted to deliver that on a spreadsheet to us with the critical information, we can coordinate that. And certainly if there's numerous properties, we can look at discounts accordingly as well. So it's always happy to work and always happy to have a conversation if there's something sort of outside of the box. So look, I guess I just want to sort of just finish up, just saying, look, we are experts in all asset types across the country. We've worked to provide a product that we can deliver on a timely basis and a cost-effective basis. We've tried to streamline the process. So those web forms that you just saw, we want to make sure that we capture that information that upfront that causes in the past the rework and causes downtime for everybody in the process. And from Paul's walkthrough, you can see that those reports do meet those ATO guidelines and provide the information that's required there. And last but not least, just some of the other services that we do. We do a lot of work in the legal litigation space. We do tax depreciation schedules, and that's all asset classes. So that's residential, commercial, and agri. I know there was quite a few questions around agri, that there's significant deductions in tax depreciation on agri farms. We can do your sort of general sort of valuation work from capital gains, stamp duty, etc. And we can also help people with sort of acquisition, tenant representation services. Just a bit of a plug. Once a month, we release a very informative newsletter that will, if you're interested in property, it covers residential, it covers commercial, it covers agri, it will deal with self-managed super funds, insurance, construction costs, and a whole suite of services. So if you want to sort of scan that barcode, obviously the presentation is going to be circulated later. Feel free to scan that and sign up. Last but not least, and there's been quite a few questions raised, I think we've left about 10 minutes for some questions. So
maybe I'll read out the questions and then both of you can maybe add some comments.
Fantastic. Thank you.
So question there from Katie. Is there any rules, I guess, or do you have any policies on how often a valuer should actually cite the property, including insights? So maybe, I don't know if you want to give an answer on residential versus commercial too.
Well, look, a lot of information. So we ask the information to try to collect the information for, I guess, your more, let's call them vanilla or generic type properties. So we've got good information on that, like residential. We probably don't need to go through and do a full inspection. But then if we get something that's more of a specialized asset, maybe it's a hotel, maybe it's a childcare center, that's where we'd probably want to go through, have a look at that initially, and then sort of set the parameters for some sort of annual sort of updates that are done on a desktop basis.
And I do. And I just, obviously, the slides, I don't know if they're going to be made available, but go back and have a look. That report that we're providing for the non-residential is a desktop assessment. So it's not a full valuation. So what we would say is, generally we'd like to, and we're happy just to do that desktop, but generally probably once every 3 years we would recommend a full valuation be undertaken. That way we can gather all that information, and then for the following couple of years we can do desktops. But not to say that we won't just do a desktop if we've never seen the property before, because ultimately it's a tool that's helping the trustee ascribe the value to the property. So
Yeah.
make it clear. Yeah.
And look, and I guess, look, one of the other points when it comes to full inspections, if it is a transaction, so it's not for audit purposes and it's effectively setting the market, we would always have the preference of going through and doing a physical inspection on those particular transactions.
How do you ensure that renovations and additions to a residential property are accurately included in a valuation?
Oh, well, look, quite simply, we do ask a lot of information. So once you've confirmed that you're proceeding with us, we will send out and ask information. The information in the web forms allow people to take photos or submit plans. So we've kept it very open. So you can provide us as much detail as you possibly can. As valuers, the more information, we love information. So don't be shy. If you've got the information there, if you've got photos, please send them through. And that'll make sure that we take into account those renovations and capital works have been completed to the property are included.
Question, and this might be different, I'm assuming, depending on the type of property too. How long does it take to get a report?
Look, residential properties, you'd be looking sort of 2 to 3 sort of working days to get that done. Commercial, it'll depend. If it's quite a sort of vanilla type property, we'd be looking at 7 working days. That's once we've got sort of all the relevant information from the client. If it's a more specialised asset, when we provide a quote, we'll also talk to the client, understand what their deadlines are, and agree to a turnaround time to deliver that report.
There's a lot of different questions there on the how much is the fees for the different valuations. So what I'll do too is also get our team to include a link there to that particular site there, Nathan, and that gets sent out to all attendees as well.
Excellent.
Do you provide rental appraisals for commercial properties?
Yes, that is one of the data points that we discuss in all our SMSF. So even if someone just said, can I have an SMSF valuation report? As part of that valuation report, we also ascribe a market value assessment as well. So that's in every one of our reports.
Another question there, can you order tax depreciation reports as well?
Yeah, so the tax depreciation, you can order that through that same link. So yeah, so the self-managed super fund is one channel on that link. Tax depreciation's one channel on that link. If the residential property in sort of a major metropolitan area, you can get an instant quote as to what that fee is. Obviously, if it's commercial or agri, we need a little bit more information and we'll work up a quote on that, but you can still request that. And one of our team members will get in contact with you through that link. In addition to that, any of our other services on the right-hand side, there's another link there. So any of our other services that you may be interested in, could be a family law matter that you need property valuations done or something like that, can all be ordered through that same link. So, you know, obviously some of them is just our team members will get back and communicate with you and provide a quote, but you can access all our services through that.
Question, how is the pricing determined for dryland farming properties valued at more than $3 million?
Over 3 mil, that's again via a quote process. So we would engage the local agri valuer, depending on where it is, to have a look at that. And look, they could have quite a bit of experience in that area, so they can still provide a desktop and provide it at an affordable price.
We had quite a few questions about, I guess, access to the slides and recordings. So just to recap that, a link to today's recording and the slides, and we'll also include a link to the pricing page will be sent out to all attendees today as well. Question there, which is a little bit different. Are all your state offices interconnected or separate franchises? And I suppose I think the second question we already covered, but does the price vary from desktop versus site valuations?
No, we're 100% owned business, so all our offices are very much connected. So if it comes through a central point and we need to get it out to a remote or regional office, then we can certainly do that, and they're aware of the pricing guides as well.
And
So it should be consistency across all our offices.
yes, thanks, Nathan. And just to chime in there, yes, obviously there's a difference between our desktop assessment, which is sort of $600 for sort of up to $1 million, 2 tenants, and a full valuation assessment, which for the same sort of property in a metro area might be $1,500. So there's sort of roughly a bit of an indication there.
Question from Philip. Do you have an app? So I'm not too sure if they're talking about the ordering process there or not, but
no, we don't actually have an app. It's all through our online link, which can be accessed on obviously all different types of devices.
Question would be vague, so maybe I'll rephrase this one. How does, I guess, your valuations compare against a bank valuation?
Look, they're different purposes, but market value definition is essentially the same. So look, what the bank valuation has been done, whether that's been done as a full or a desktop, will depend as well. But look, in essence, market value is market value. There's probably a misconception out in the marketplace, going back a number of years, that maybe a bank valuation is conservative, but that's generally not the case. Market value is market value. So from that perspective, there shouldn't really be a massive difference between a self-managed super fund assessment and a bank valuation. They should be fairly consistent.
The only difference for a full valuation is obviously the bank have a lot more requirements for us, standing instructions that we need to adhere to. So there's a lot of commentary on advising them on, SWOT analysis and risk assessments and things like that. But yeah, ultimately it's the same process to create a bank valuation as it is a valuation for a self-managed super fund. It's just a different reporting template that we're using.
Is a site inspection required for a tax depreciation report?
Generally, we would prefer to do a site inspection to make sure that we collect all the deductible items, make sure we get out there and have a look at it. But yeah, often if it's recently been constructed and we've got plans and specifications or detail, or it's in a remote location and it's a bit cost prohibitive to go out there, we can certainly work with the client on an alternative way of collecting that data.
There's a question there about, shorten a bit, but about, I guess, zoning. So rezoning a property from a farm, I guess, a rural property to residential, and obviously that would have a huge increase on the valuation depending where it is. I guess what kind of factors would go into that, or what's the approach, etc.
Yeah, look, good question. I guess if it's been rezoned, our approach is we look for transactions that have the new zoning as well. So we look for transactions of other larger globo parcels that might have a residential zoning. Even though the previous use may have been industrial, it's now got a residential zoning. We'll compare it against other properties that have transacted with residential zonings. What we do find sometimes is that if a property's got a residential zoning and the vendor has also gone through and got a development approval, and that development approval may have taken sort of 18 months and a lot of money with town planners to achieve, there's a significant increase again in value, because the new buyer can basically walk straight in with that approval and start construction. So there is differences there between two blocks of land that are both zoned for residential development. One's already got the approvals, that's worth more than one without them. So we look at all those details in the sales when we're comparing it.
Last one, I'm going to treat this as the last question now and consolidate a couple of questions into one. So there was a few more asking questions around the, I suppose, real estate valuation ranges again, and I suppose why a range, it's hard to predict, I guess, a number in there. And I guess I'm going to probably add to that, why is one of your valuations, I guess, superior to that of just a real estate agent valuation?
Well, look, first of all, we know that the range from our conversations with accountants and auditors does cause issues and reworks, because they need specific numbers to work off for the reporting purposes. So I guess it's, you know, making sure that the person that you're getting to do your valuations has a good understanding of what's required. Further to that, there might be a market value provided, but not a market rent, which, as I mentioned before, creates a lot of rework. And look, I guess at the end of the day, we're property professionals. We're independent, and basically, if you know, the client, if we need to sit there and look, we'll be in a court of law to sit and stand behind our valuations, if required. We do that from time to time. We'll sit there and back and support our valuation. Yeah, so I think that's the key difference, and something that we do all day, every day.
That's great. So we'll bring the webinar to a close now. So Nathan and Paul, thank you very much for your time today. And I guess to all attendees, thank you for attending. As I mentioned earlier, a link to today's recording and the slides will be sent to everyone. So thank you everyone and have a great day.
Thanks, you.
Thanks, everyone.
Bye.